Hi, my name is David Teague. I tutor accounting, and this channel is for accounting students. So if you're an accounting student, this is for you. I'm going to treat this like I am your tutor, but if you actually want to tutor with me personally, please email me and I will arrange with you a free session so that we can talk about your class and see if we can set something up. The purpose of this video specifically is to practice analyzing transactions, real transactions from a textbook that you might be seeing yourself, very similar transactions. There really are only a certain number of them. And I want to talk about what their impact is on the accounting equation. So do they increase assets, increase liabilities, decrease equity? What's their impact? So I'm going to go through that. I'm going to go through 10 examples in this video. So let's get started. Okay, so I've put myself in the bottom of the screen and hopefully I'm not blocking anything with my face, but I've got some space here to write out these journal entries. So I'm just going to go through this. Number one says received $19,600 and issued common stock. What does that mean? So let's talk about the accounting equation up here. Assets equals liabilities plus stockholders' equity. And we can try and draw a line to separate our transactions here. So let's do number one here. And we issued common stock and we got cash for it. So if you're wondering what kind of account common stock is, it's equity. And I've got a video that I can link where I talk about where all these accounts go, what boxes do they go in, what statements do they go in, and so we would know then that equity includes common stock, and we're issuing it. That's an increase to equity because the shareholders themselves now have more equity. So the shareholders' equity therefore is increasing. And what do we get in return? We get cash. So that's an increase to assets accordingly. So yeah, that's an increase to assets. And so then number two, I might switch the color here just so we can see better. Number two is purchased $900 of office supplies on account. This is a nice technical thing here that we see on account. We see on account all the time. We got one there. We got down here. We collected on account. We performed service on account. So this language comes up a lot, on account. So what does it mean if we buy something on account? Well, in this case, we purchased supplies. Supplies are a resource to the company. They count as an asset. So that's an increase to assets. The fact that we paid for them on account means we didn't pay cash. We paid with debt instead. We now owe for them. It's like a tab. We got something, but we're going to pay for it later. So we have more debt. Liabilities are debt. Payables. So that's an increase to our debt, and now the accounting equation balances. The left side is balancing with the right side. We didn't mess anything up. Number three, we paid $14,600 of cash for land to use as a building site. The fact that they're using it for a building site isn't that relevant. It does sort of tell us that it is a business transaction. They didn't just buy it for nothing, so it's really not going to help us. They're not going to try and trick us with anything like that. We paid cash though. That means cash went away. We lost assets. And what did we get for that? We got land. Land is an asset. It went up. So that's an asset exchange there. We exchanged the asset of cash for the asset of land. So the overall equation is still balancing. So you're seeing this pattern here where no matter what happens, whatever this transaction is, it's going to impact two things, and the equation will always still balance after it. We don't even need to put the numbers in there at this point to show that. It just has to be the case. It will always balance. So number four, we performed service for customers and received cash of $2,500. So again, we received cash. That's an asset going up right there. So you can usually see what's happening to cash and use it to get started. So now we can look at the other part of it. We performed service. Performing service always means revenue. Revenue is part of equity. So remember, inside of equity, you've got common stock here, and you've got retained earnings. And inside of retained earnings is net income and dividends. Inside of net income is revenue and expense. All that is packed in there. So the revenue went up, it drives up the entire thing. So that's why it's a plus. And expenses would be the opposite. They would basically be bringing down the whole SE as they themselves go up. So number 4, we've performed revenue, we've got some service revenue there, and then we increase our assets accordingly. Number 5, we paid money, cash, on account. There's another on account. But now we're paying cash on account. So I know for sure we're losing cash. I don't necessarily know, I don't have to know yet what the on account part means, but I know that we paid $200. And that means money right there. That means cash. Now, on account, what do we do with that? Which account? Is it a receivable? It's not really a receivable if we're paying. We're not borrowing money from a bank where now we have a receivable. This is more like we're paying an account payable where we owe money and now we've paid it. So what happens when you pay off money? When you pay money towards something that you owe, you no longer owe it. Your debt decreases. This is a minus to liabilities. So before we purchased on account, we had more assets, now we had more debt. So before we purchased on account, now is the other part of it, where we pay on account. We actually pay off the debt. We're paying the tab. So that always comes after. So number 2 here kind of connects with number 5 in that way. Now, number 6, let's see what's happening. Perform service, again, on account this time, though. So we saw before that service is a revenue, and it's a positive, service is a revenue, and revenue is a positive equity account. And so that's a plus over there. Just because we see perform service, we automatically know we're increasing equity. But then we also see on account. So we're not getting cash here. We're going to be paid later. But guess what? Being paid later is still an economic resource with future benefit. It's still something valuable to us. So it's an asset, and it's increasing. So that's 6. Now, that's also another one of those on accounts. And what happens when you perform on account? Later, you collect the account. We get money. So what happens when we get that money? Our cash goes up. So we got some cash here. But then what else happens? We're no longer owed that money. Someone gave us the money because they owed it to us. Now they no longer owe it to us. So we're going to reflect that by getting rid of the account receivable that showed that they owed us in the first place. So again, it's an asset exchange that's happening here. And that's how these are the 4 on accounts. You purchase on account, then you pay on account. You perform service on account, then you collect on account. Those are the only 4 on accounts that you'll see, and they tend to be the most confusing of all these transactions that you see. So I'm glad that we got these in the list. Now, number 8 is paid the following expenses. So that's nice. They told us that they're expenses. That automatically means our SE over here is dropping down. And it says we paid them. That means we paid cash. So we're losing assets here. And we're done. We don't have to worry about the numbers at this point because we're just showing pluses and minuses. Although all the way through here, we could have also been showing the dollar values, but I didn't think it was important at this time to show that because I really just want to show the impact on this equation. So then number 9, what do we have here? We have the business borrowed money, signing a note payable. So if you borrow money, what do you get? You get money. What is money? Money is cash. Cash is an asset, and it's going up because we have more of it now. But what else happened? We owe the bank money. You borrow money, you have to pay it back. So in my other video, I talk about where all these accounts go. All liabilities are payables except for unearned revenue. Unearned revenue is the only liability that's not a payable. So a note payable is a liability. We now have one. Why do we have it? Because we owe the bank money. Why do we owe the bank money? They let us borrow some. So when you borrow money, you have cash and you have debt at the same time. That's what just happened. All right, number 10 for the last one here. Pick my color here. Let's see. It's been a while since I've used purple. Number 10. During the month, the business earned a service revenue. Boom, right there. We got more revenue going up. Don't even have to finish the sentence. Received cash for half. Interesting. So now I'm going to put the number 7,700 going up for equity for the revenue. So 7,700 goes to the equity, and then half of it is cash over here as this asset, going up 3,850. I definitely checked this on my calculator because I do not trust my own head math. And then we have accounts receivable for the rest of it. Why? Because they still owe us the other half. They paid half, they're going to pay the other half later. Happens all the time. Still, assets go up for a total of $7,700, which offsets the equity. It's just that it's two different asset accounts. No big deal. Half of it was cash, half of it was on account, basically. We've already seen what that looks like when it's on account. And then we've got revenue. So these are just 10 transactions. There are other ones. If we declare dividends, that's a negative stockholders' equity event. We pay them, that's a negative asset. So, there are other transactions we didn't talk about. There are also adjusting transactions where we do adjusting journal entries, and that also impacts this. But I wanted to just cover the beginning ones, the ones that you're going to see like in your chapter 2, where you're just getting introduced to these things. And now that you know the impact on this equation, understanding debits and credits is going to be much easier, because then we can see we're getting used to this language of increasing and decreasing things and what that means when we're talking about debits and credits. So that's where I'm going to head next. If you follow my videos here, my next video will be on the debits and the credits of all of this, because then we talk about journal entries after that. So this is all part of the flow of most textbooks and of most classes. So thank you for being here. If you want me to be your personal tutor, please reach out to me, email me, and I will meet with you through Zoom or something else, and we will we'll get it done. You'll save a lot of time. So please do that, and also like this video, subscribe, and I will see you next time. Thank you.